Well, it's seeing us much higher, actually, a little while ago. In fact, when the market first opened and got wind of an inflation report on the retail side that was better than expected, they were seeing nothing but clouds. The Dow up almost 800 points. That was then. We've since given up a large chunk of those gains and then some for the Dow. So too the NASDAQ and the S&P, although they're still in positive territory. The news was, of course, that November retail inflation was up about 0.1% for the month. That was a lot less than the 0.3% estimate, and that the core, minus the food and energy, which tend to be volatile, although you can't go through life without them. Anyway, that was a little less than expected. And year over year, we were running at about a 7.1% clip. Think back in June when we were running at about a 9% clip. But again, as Brian Brenberg pointed out to me a little while ago, still a 7 in front of that number year over year. Now, that we're showing you the core chart there, but year over year on the general number, of course, 7.1%. So what to make of the market's reaction to all of this? We've got Jim Bianco joining us, Bianco Research President, macro strategist. Danielle DiMartino Booth, kind enough to join us as well, the former Dallas Fed advisor. Danielle, it is in that role that I'd like to pick your brain on the Fed, and if it moves on this number today, or it's ready to pull the trigger on another half-point hike expected tomorrow. What do you think?
I think we will see a half percentage point hike, and the market's going to then turn to what the prospects are for the February 1st meeting, the first of 2023. Of course, there's a voting rotation that occurs after tomorrow's vote. So we'll see a few more doves come on to the Federal Open Market Committee. And then, of course, there's the press conference. And I think what investors should be focused on more than anything else is how long Powell indicates he intends to keep interest rates at a very high level. Things begin to break, whether you're talking about Uncle Sam's finances or trillions and trillions of dollars in private equity that might have to be marked to market. That could become problematic for U.S. public pensions. There are a lot of different factors that go in, except for just 1 or 2 months of downside in the CPI. And I think markets are beginning to read in that Powell's going to look past this and stay more resolute than they would prefer.
You know, Jimmy, you think about it, we started the year at around 0%, right? Now, we're going to be looking at, as things stand now, 3 3/4 to 4%. Maybe after a half-point hike tomorrow, 4 1/4 to 4.5%. That's a big advance. And I'm wondering if that reality is setting in here. And a lot of people are thinking we've yet to feel the impact from that. What do you think?
Well, I do think we haven't felt the impact from it, and I do think that that reality needs to be set in. The market has never really priced in what we refer to as the terminal rate. Where's the Fed going to peak interest rates at? 5%, 4 3/4, 4.5%. It's always been pricing in, well, rates are going to be back to 3.5 and on their way back down at the end of 23 and in the early part of 24. And if that reality sets in, as Danielle says, look, they're going to go up tomorrow. 50 basis points is a done deal. Anything but that would be a massive surprise. And maybe continue to raise rates again in the January meeting and then hold there for the rest of the year. That will be eventually be seen as a disappointment to the market, because the market expects the funds rate's going to be at 3.5% on its way lower by December, by 1 year from today and into early 2024. And that's what it's been pricing.
Oh, really? So looking at the futures, Fed fund futures, though, they're factoring in a Fed funds rate a little south of where we are now after climbing, to close to 5%.
Yeah, the market is still, the word we're not allowed to say in economics is transitory, but it still believes that. It has always believed that inflation is transitory. That never really went away. And therefore, they've always thought that somewhere out in the future, rates will start coming down when we start to realize that this inflation thing is behind us. And when we start, if we start to think that, no, that might not be the case, that yes, inflation is coming down, but it's not going to go back to 2%. It might stay at some level higher than that. And interest rates are going to have to stay, the phrase Wall Street likes to use, higher for longer. That will then become a problem for the market, I think, in 2023.
Real quickly, Danielle, the Fed meeting did start today on Eastern Time, wraps up tomorrow. How much of the discussion will be this retail report today?
I think that it will definitely be a focus. But by the same token, we're talking about a bunch of economics, a bunch of academics here. They know that that shelter inflation of 7.1% year over year, much higher than it was at the peak of the last housing boom, Neil. They know that that is problematic and sticky, and it's going to remain in the data for months to come. That is going to keep the Fed under fire to continue fighting this inflation fight. As Jim said, that is not what markets are anticipating when they use the word pivot at all.
All right, guys, don't wander too far because I want to pick your brains on some big purchases going on among some big companies, including a lot of them buying some big old super expensive airplanes. That's coming up later in the show.